Thank you for taking the time to watch this video. This is about Escape Hunt's final results for the year ended the 31st of December 2020. Of course, 2020, not a normal year. A global pandemic, pretty much a global recession. The economy was shut down, but there was some bright spots. Okay, let's get into it. The content of this video does not constitute investment advice. Do your own research. If you do invest in anything mentioned in this video without doing your own research and the share price goes down, you only have yourself to blame. However, if the share price goes up and you want to give me some credit, I'm happy with that. Escape Hunt, ticker ESC. Final results, 31st December 2021. These are the financial highlights. We'll go through operations as well. But financial results are not going to be flattering. Why? Well, there's been a global pandemic and the economy has been shut down, forcefully shut down. And of course, they operate in retail outlets. But definite bright spots and the sun is emerging, which I like a lot. So let's go through it. Group adjusted EBITDA, its earnings before interest, tax, depreciation, amortization, reduced. So their loss went down by 300 grand from 1.7 million in 2019 to 1.4, despite COVID restrictions, which is very good, I think, very encouraging. And also up 25% like-for-like sales on a 12-week rolling basis in the 2 months prior to lockdown. So demand is there, growth is there. When you're looking for a growth company, you've got to have demand, and that kind of demand is there, 25% up. I always look for plus 20% for a growth company, that's 25%. But if you dig deeper, look at this. On next 5 sites and all 8 matured sites, up 44% 4 weeks, up 59% over 12 weeks. And in fact, on the next 5 sites, up 70% and 99%. That's growth. You know, people want to play these games with Escape Hunt branding. They like them. There's demand there, okay? That's what you gotta look for. It's pointless having a good idea if there's no demand. They've got the good idea and they've got demand. Group revenue, 2.7 million, of course. Not that impressive, but they were shut down for most of the year, so surprised they did anything. Previous year, 2019, 4.9 million. Now, they generated 4.9 million, okay, off only 8 sites. That was in 2019. They now have 19 sites, okay, in better locations. The locations are getting better because commercial landlords are struggling. They've got empty units they want filled. This is where Escape Hunt is taking advantage of this. They're getting better offers. Now, previously, before COVID, they would not be able to afford these, premium, high footfall retail outlets. Now they are. So these sites are in better locations with higher footfall and also better margins. I'll get into that in a bit. So several metrics there improving, okay? You've got to look forward with the stock market, not behind. Revenue from digital and other play-at-home products was 230k. This is pretty much in December. They didn't have this product. This is the mark of a quality management or board or company. When faced with massive challenges, you pivot. You try and find a way to earn money. They invented digital and online. Now you imagine having no business and within the first year doing 230k straight off from nothing to that. And that's just a start. And there's been uptake here. Corporate companies opening accounts for them, so it'll get better. They've also got 3.3 million of cash. Plenty of cash. One of the biggest worries about small cap companies, if they're not generating, free cash flow, where are they getting the cash from? Have they got enough cash? Yes, plenty. 3.3 million. Escape Hunt, this is a market leading. I've got to frame this right. Some people don't get this. This is a market leading, high growth company in a new leisure sector. There's huge demand, for leisure and optionality. At the moment, you look around bowling, you've got all these high footfall retail centres, bowling, cinema, anything else we can do in here. Because eventually, people can only see enough films or go to bowling times. There's going to be other things. Okay, restaurant. What else can we do? There's another option. There's another game in town. So look at this. This is a little mix. And they just did a question and answer session with Heart. And they mentioned, one of them said, one of the most fun things they've ever done was an escape room with Ariana Grande. Would they say that about bowling or cinema? I went bowling with Ariana. No, escape rooms are more fun than that. So what percentage of your friends or family have been to cinemas or bowling? I'd say pretty much up there in the 90%, Cinema, 100%. It's a saturated market. It's done. The growth there is done. Now, ask yourself, how many of your friends, percentage-wise, have been to escape rooms or family? Not many. you know. And these are this guy there, Peter Mulholland, excellent manager of an escape room in the Corn Exchange in Manchester, right in the middle of these cinemas and these restaurant areas. There's this entertainment venue called Escape Hunt, right? People think, what is that? Because it's high footfall, people will try it, you know. And so what I'm saying is the same high footfall retail locations as bowling or cinemas. Sooner or later, people will just go in there and try them out. Okay, they also advertise online, but when you have this, millions of people coming through these high footfall retailers, they're going to try out a new leisure activity. Why not? And I tell you what, it's more enjoyed by a broader demographic than bowling. Generally, bowling is for blokes. Women like escape rooms, by this little mix there. It's a new leisure option. Simple as that. It's going to be there. There's a new player in town, okay? Operational highlights. Let's look at this. So, owner-operated sites expanded by 56% to 14 sites. This is up until December the 31st, all right? Record opening performances at each of Norwich and Basingstoke sites. I went to Basingstoke, had a great time arguing with the family in there. We're all just trying to do different things at once. And, stop pressing all the buttons! We don't know what you're doing! So, it's fun there. All 8 sites open for more than 12 months were named TripAdvisor as Traveller's Choice winner. So they're high quality, in excellent locations, good branding, the best, market leading in August 2020, and continued 5-star TripAdvisor ratings across the UK estate. So people are liking them, they're going to them, there's demand there, and they're liking them. And they're in high footfall locations. Transition to a new lower cost games, a supplier and installation for first modular games in Watford. So the margins are going to get better on these. As time goes on, economies of scale will kick in. So post-period highlights. Kingston, opened on the 17th of May, taking the owned and operated estate to 17 sites. Okay, heads of terms agreed on site in Milton Keynes. Legals close to completion. Work commencing shortly at a new site in Lakeside. By the way, Lakeside annual footfall, 20 million people going through there. That'll create some excitement. Some people are inquisitive. Let's try that escape room. We've heard about escape rooms. Let's try it. It's a new leisure option. These are the market leader. How many leisure companies do you know that's a market leader that will be in all of these retail centres? They're valued under 200 million. This at the moment, valued sub 40 million. So inclusive of Milton Keynes and Lakeside, owner-operated estates have grown 111% compared to 31st December 2019. Digital downloadable sales continue to perform, generating £92,000 in 3 months to 31st of March. They just started this. Literally, it's kicking off, the digital. Other points. I keep saying this. No other leisure company have achieved this level of growth in a global pandemic with lockdown. Of course, they're not going to achieve financial growth. They can't. But operationally, they've grown. They weren't allowed to do financial growth. They were shut. But in the background, they're doing deals and they're opening sites and they've still got cash. That is a mark of class. A management who know what they're doing. You imagine when the economy is full open now. This, again, is a market-leading, high-growth company in a new leisure sector. Think about that. That's big. Owner-operated sites grow by 111% during a lockdown. Now, this is the chairman. When we raised money in July in 2020, we set a target of 20 owner-operated or managed sites within 2 years. We expect to achieve this before the end of 2021, 6 months ahead of our target. Easy going to get there. They're on 19 already. We've got more than 6 months left, I think. This is Richard, CEO. In November, we implemented changes which have enabled us to convert over 80% of what were previously fixed costs to variable costs. This change will result in lower break-even points at all our UK sites and ultimately should lead to higher operating margins. So not only at this is employees having more flexible contracts, not zero contracts as they asked. So no, they just wanted more flexible, so that produced our fixed cost apparently there, and now it's variable. But also the games themselves are becoming more affordable, cheaper, they're becoming cheaper to produce in scale with a different supplier. So they've got both these employees, administrative costs, and sort of group capex costs coming down, margins going up. Okay, and this will only get better as they scale. Directors believe that once a new site performance has matured, the escape hunt network should be capable of supporting positive EBITDA and positive cash generation. That's 17 sites. They've got 19. These are where they are around the country. There's Edinburgh, Manchester there. There's 2 in Birmingham. There's Liverpool, Norwich, Leeds, Milton Keynes on legal inside, Oxford, Watford, Lakeside, Brussels, Kingston, Reading, Paris, Bristol, Cheltenham, Birmingham, Liverpool, one in Dubai. Okay. Current sites 19, short, medium term target 20, mid, long term 50. Now, this is Into. Into is a commercial operator, one of the biggest commercial operators of commercial sites across the UK, shopping centres and stuff. They went into administration, and so of course they're having issues. The administrator is trying to find people who can take up these empty lots, empty units in these sites. At the moment, the ones I've highlighted here are the ones they already have escape hunt. Look at all the options there. So we've got 1, 2, 3, 4, 5. There's another 20 sites there at least, in big areas: Westfield, London, Metro Centre, Gateshead, Trafford Centre, Manchester, Stratford, London, Bluewater, Kent, everywhere, Bullring, Manchester. There's loads of them. Loads of them. St David's, Cardiff, that'd be nice. St David's, Cardiff, all over the place. So there's plenty of options in the UK alone. Valuation. That's what I'm saying. So sites only. This is not doing anything else. Based on EBITDA of 150k per site, on a multiple of 20, £3 million per site. That's in the broken notes, and that's what they're achieving. That EBITDA will go up. As they will improve. Okay. So this valuation does not include virtual games, play at home, outdoor, franchisees, which have high margins. I'll talk about that in a bit. Other products, economies of scale, market leader premium. Doesn't include that. Okay. So at 19 sites, at 3 million per site, you've got 51 pence at the shares in issue at the moment. That's how much it costs. Okay. 34 sites, you're breaking £1, £1 and 2 pence. And then at 50 sites, you've got 156. Okay. Now, that's the EBITDA multiples there. Times 15, up to 17 sites, 20 thereafter. Fast-growing company in a new leisure sector. That's conservative. Average is around about 10, 15. And this is the market leader in a high-growth sector. New leisure sector, so 20 is not a stretch. Current, let alone future potential, isn't priced in yet. Like I said, at 19 sites, you're at 51 pence. We're now at 40 pence. So this valuation does not include this, games online. So let's try it then. Let's try and put a value on these virtual games, play at home and outdoor, okay? Revenue from digital and other play at home products was 230k, nil in 2019 because they just invented them out of nowhere and had a massive game. In fact, one of the games they did replicated the entire physical site in as much as customers playing in the game. So mostly November, December. Digital lockdown sales continue to perform, generating 92,000 revenue in 3 months to the 31st of January. So let's do 4 quarters of that. And let's be honest, the first quarter, it's going to be quite quiet anyway, you think, wouldn't you? So because the last quarter is the busy quarter, Christmas parties, all that stuff, even in summertime. So 92k times 4 is 368. That's 60% growth on the digital side. But I think it'll do better than that, like I said, because I think end-of-year parties and all that stuff, Q4 is where they'll really be ready for it this time, whereas last time they literally created quickly. So this is going to be very exciting this year, digital. But the margins on this are massive. They're 80% digital. 80% margin, EBITDA margin. So even if, like I said, this year's 230 they did, that's worth about 3.6 million to them on a multiple of 20. That's worth 4 pence, the kind of share price. Now, I've done sort of 60% growth next year, then 50, 40, 30, 20 have gone down because of the bigger the revenue gets, the harder it is to get the percentage gain. But even at 2025, 1.3 million is worth just over $1 million EBITDA to them, times 20, and a multiple of 20 is 20 million. That's 24 pence. That's the valuation's worth, okay? So let's look at the sites alone. 156 plus 24 is 180, okay? Let's look at franchisees. This is going to go gangbusters in America. They're just starting this, and they've got big ambitions out there, but around the world as well, but in America especially. Now, I've only done 20% growth on this, but the margins are higher than 50%, they will be. But revenue on this year was like 600k, and the EBITDA was 300,000. Multiple of 20, that's 6 million, worth 7 pence, okay? Once they get to 2025, it's growth of 20% a year, could be more than that. I think that's conservative. EBITDA is worth 746, worth 14 million or 17 pence. We got 180 plus 17 is 197 the price there. That's the franchises now and virtual, okay? Does not include other products, economies of scale, market leader premium. So let's say 197, £2. Okay, just on EBITDA of 20. Not a stretch for a fast-growing, leisure company, in a new sector there, a market leader. Let's try and price in that market leader status, okay? Because when Escape Hunt is in most high footfall retail centres in the UK, its brand will be as recognisable as other national brands. Very few of these national brands are sub, £500 million, The number of sites, their premium locations and brand recognition brings advantages. Brand recognition equals increased bookings, better margins, more opportunities. Because they've already hooked up with the BBC, people like that, and for Doctor Who and Netflix, for Enola Gay. That's the other kind of opportunities you get, sponsorship opportunities, all that kind of thing, okay? Economies of scale, bigger margins, larger profits. The number of sites plus premium locations and brand recognition means they get a market-leading premium. Look at any company that's listed. The market leader is valued way out and ahead of anyone else or all of his competitors because they are the first port of call. Their margins are better. Everything's better about them, And so the top dog always wins. It's always good to try and take a disruptor, something very little, or a challenger. But very rarely pay off, very rarely. So this means the multiple increases. So not only their margins getting bigger, but their multiple of the valuation increases, okay? So I've gone from, let's say, I was looking at stuff like Fever Tree earlier on, and they were on multiples of 70, 80, 90, and even, what else? Assos at the time, way above 60, 70. So I've just gone from 20 to 30, because these are market leaders. And even, Rightmove, if you look at Rightmove, for example, they're on like 25 times revenue. But so I've looked at this, and I thought, let's just give them a 30. That's revenue, not EBITDA. Let's give them a 30, multiple on EBITDA. So when they have 30 sites, they will be so far ahead of other competitors, they will have market dominance. Right now, they have that. There are 19 sites. I think the nearest competitor has about 4, and they're not listed. So they haven't got access to capital, and, all that stuff. So let's look at this. On a 30 multiple, all right, valuation. So 51 events, and I've gone from 15 there, 20 sites, 7 to 30, only on a 30 multiple after 30 sites. Okay, because that's when they get the economies of scale and market dominance and all that stuff. So at 34, you got 1 to 17 rather than 1.2. And then, let me just move my head out of the way. 198 on 50 sites alone, just 50 sites, okay? Then let's go to online played, and let's do the same this, 30 multiple. So worth 35 pence in 2025, same growth rate. Okay, so that's 198, 35, 233. Then let's go franchisees. Again, 30 multiple. You got 25 pence worth of 2025. These are not, over-the-top growth figures, 20% each year. That can be expected quite easily. You're talking about 233 plus 25 is 258. Do you know what? I see it going bigger than that. I really do. Once you get momentum behind a market leader and the funds start piling into it, it overshoots any reasonable evaluation. So that's 545% up on the current SP of 40 pence. And what I like about this company, every time they announce a new site, it's a value step up. Pretty much 3 million on a conservative basis. And that's not including all the other products online. Every site, more money. Every site they're generating more money. Every site they're generating more. And they're only at 19. They're going to get to 50. The market is about looking forward. How far can you look forward with certainty? Well, they've got a roadmap here to 50 sites. They've only done 19. You can't get more certain than that. They're operating in the UK, not some far-flung, questionable jurisdiction. This is why I like Escape Hunt. Thank you for watching. If you made it this far, I appreciate it. There's a lot in there. But listen, I'm very biased and I'm very bullish on this company. Yeah? Do your own research. But I genuinely think it's going to be a market. Well, it is a market leader, but the brand will be nationally recognisable. Like I said, you'll walk into any high footfall centre, and there will be the option to do an escape room from Escape Hunt, like you would do bowling or cinema. That's why I think it's a very powerful brand, and it's going to go from a micro cap to a mid cap. That's genuinely what I think. If you like this video, by all means give it a thumbs up, share it, subscribe to the channel. But if you want more exclusive information and join a club of like-minded investors whose aims are to become better investors, then head over to sharepickers.com. Thanks for watching.